PayPal is no longer a value trap. It's no longer a dying company. It's no longer just a dying value investment. Not because PayPal came up with a massively innovative product, not because PayPal discovers the next AI or crypto or whatever it is. All that happened is the stock went up. And this is, I would say, welcome to Investing 101. This is what happens. The stock is going down or it's staying flat while the market's going up. It gets called the value trap. It gets called all those names. Value investing is that, all these kind of things. And then when the stock starts going up, all that stuff goes away and the sentiment changes. And not much changes with the company. PayPal is still growing the same pace. It's remained consistent and the market has been so far rewarding it. I wouldn't be too excited because over the last 5 years, the stock has been a disaster. But I believe the rally is only getting started. I'm going to tell you why. I'm going to give you my update on PayPal. I'm going to give you the upside potential that I'm seeing from here if you're thinking about buying PayPal at $77.31 per share. As I said, they didn't have anything innovative like the CEO said, they're going to shock the world. It hasn't really happened. I mean, they have the Fastlane product, and it's not bad. It's improving a few things in the company, but it's nothing major that was innovative that pushed the stock to go up. All that did was PayPal remained consistent, and the market is rewarding it for being consistent and not being called a declining company or a value trap or whatever it is. They did roll out crypto capabilities for US business users. I'm not sure the impact, the significance of the impact, because I don't get involved in crypto. I don't invest in it. I don't talk about it too much. I stick with stocks. But I think Square has the same thing for business users, and now PayPal has the same. So maybe that was something. But again, nothing major has changed with the company. They're still growing revenues 8 to 9%, not a dying company. Payment volume is still increasing 11%. Everything is moving pretty much into the right direction. Active accounts has increased quarter on quarter. Monthly active accounts has increased quarter on quarter. And everything is improving. Everything is going into the right direction. And now the market is finally rewarding PayPal, especially now as we have a new CEO. You tend to have a change in sentiment. I always talk about that stuff, especially, this is what happened with Starbucks. This is what happened with Chipotle before. This is what's happening with Nike right now. It could continue. And it could happen with PayPal. It's also already happening with PayPal. But again, I think it's only getting started. And they did increase guidance on transaction margins. They increased guidance earnings per share from 365 to 388 to 398. This is a massive raise. In terms of guidance, they did a lot of cost cutting. They also bought back a lot of stock. It's pretty amazing. Free cash flow increased by about $1 billion from $5 billion to $6 billion. And buyback $6 billion. They spend pretty much more than 100% of the free cash flows. They pretty much spend it on doing a lot of buybacks, no dividends. And hopefully they don't do any dividends because the shares outstanding have been decreasing a lot, and it's very encouraging. And I love buybacks. This is why I said PayPal could be the next NVR. You look at the chart of NVR, it's not the highest growth company ever. It's even AutoZone. AutoZone is growing pretty much the same as PayPal, sometimes less than PayPal. But when you buy back so much stock over long periods of time, you have such charts, and there's so many examples. But I did say before that PayPal could be the next NVR or the next, AutoZone. And it's best to buy back that stuff whenever the multiple is contracted. And the multiple isn't too expensive in my opinion. It's trading at 17 times earnings. It went as low as, I believe, 10 times earnings when I talked about it. It was crazy, 9.5 times even. And now it's trading at 17 times, and 17 times isn't anything crazy for a company that's growing revenues 9%, 10%, earnings per share more than 20% so far. And I'm not sure if the 20% is sustainable, but even 15% earnings per share growth within 10% revenue growth and some buybacks could be 14, 15%. This is almost one-time price to earnings growth. And this is adjusted for stock-based compensation with there's a new accounting metrics. So it's not expensive at all. 17 times earnings is not expensive at all for the company. I wouldn't be surprised if it gets all the way up to 20 times earnings, especially if the current growth is sustainable. And it looks like it's been so far sustainable. And that's why the market is rewarding PayPal. But my favorite way to value PayPal and to value the upside potential on the company is to look at the free cash flow. And I did some research and it was confusing, but I believe free cash flow for the company does include stock-based compensation. So we have to take out the stock-based compensation to get an accurate metric of the total free cash flow yield, which is what I tend to look for. Now, PayPal, they did guide 6 billion in free cash flow. And they do have stock-based compensation last year of around $1.5 billion. If you take it out, this is around $4.5 billion of free cash flow after taking out stock-based compensation. And if you take it out of the market cap, I made those calculations already, it's around 5.8% free cash flow yield, which is still higher than what the treasuries are paying, or short-term interest rates around 5% right now. 5.8% free cash flow yield that's growing, and the company is growing revenue is 6-7%, 7 to 8%. It's likely sustainable. So the way I look at PayPal, the free cash flow yield is almost 6%. The company can grow its revenues and likely the free cash flow also without a margin expansion around 7%. I think that's fair. So you add in 6% free cash flow yield, which they used to buy back stock, and then you add in 7% from the revenue growth. This is around a 13% potential annual return for the company after it's already been up around 25%. And this is without a multiple expansion. If the multiple expand, if the free cash flow multiple does expand, or if the free cash flow yield goes down from 5.8% to maybe 3 or 4% with lower interest rates, then the return could be much more than 13% per year on PayPal. So despite the stock being up, I don't think it's too late to be buying the company. I think the rally is only getting started, especially if the growth continues to be sustainable. And so far, it looks like it's sustainable. If you're buying it here today, I see up to 13% annual return on the company. It's not the highest return ever. Maybe you could find better opportunities, although it's hard because this market is extremely overvalued. And I've been struggling to find opportunities in the United States. And this is what's been happening. And I see 13% a year without a multiple expansion. I'm not seeing a multiple contraction. As the company is finally delivering, unless the growth goes to 0%, then it could have a multiple contraction and return could end up being maybe 10%, 9%. But I think will likely be much more than 13%. And this was just my opinion on PayPal, not financial advice, just my opinion. So thank you for watching this video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.